We're going to move on to how to minimise capital gains tax, and I think there are at least 4 people who ask questions about this. So I'm just going to address that. Now, capital gains tax can apply. It's when you sell an asset. Now, it can be investment property, like a residential investment property or a business property, or it might be shares or some other sort of asset. We're just going to assume that it's a house in this example. So if you purchase a house for $400,000, for example, and increases in value to $500,000, so and then you sell it. If you sell it for $500,000, you bought it for $400,000, then you made a profit of $100,000. If you held it longer than 12 months, then it's discounted by 50%, so you divide that gain by 2. Then it's split 50-50 if you've held it jointly. So we're just assuming that a couple has bought this together, and so they discount the 100 to 50 because they've held it longer than 12 months, and then they split it between 2 of them. So because they own it jointly, they share that discounted gain. Now, we're going to talk about 2 different scenarios. One is Joe, and he's employed, so he earns $70,000 in employment income. He earns $10,000 of interest in some other investments, and he's triggered this capital gain of $25,000. Now, if he doesn't do anything, doesn't change his scenario at all, just sells the asset, then the gain, or the tax on the gain, is at his marginal tax rate. He'll pay $25,000. Sorry, he'll pay $9,625 in tax. Joe's spouse, Mary, she's not working, but she generates investment income of $37,000. She's got some other investments out there, and she's got a capital gain added to her taxable income of $25,000, and so her tax on that $25,000 gain is $8,875. Now, what can they do to reduce that tax, that $9,600 and $8,000? So total gain of $18,500. How can they reduce it? Now, what they can do, we're going to look at 2 scenarios. Firstly, we're going to look at Joe, who's a salary earner. His taxable income is $80,000. The discounted gain is $25,000. So this first column is if he doesn't change his scenario at all. His tax is going to be $28,897. Whereas what he could do is he could salary sacrifice $23,350 of his income, and then that would reduce his taxable income overall, and he would save $5,604 in tax. Now, the important thing here, and a lot of people who sell assets often do it just at the end of the financial year. If Joe sold this asset in May or June, he might not have $23,000 of income to salary sacrifice before the end of the financial year. So planning ahead a bit can work well when you're selling a large asset that's going to trigger a gain, or salaried employee, because if you sell at the end of the financial year, you potentially couldn't implement the salary sacrifice strategy at the start of the year, and you've planned ahead and you know that you're going to incur this gain, then you could potentially salary sacrifice and pocket these tax savings on the capital gain. Now, Mary is a different scenario where she can make what we call deductible contributions to super. Now, this is because she's not working, she's considered substantially self-employed. Now, what she can do, because she's not employed, she can make a deductible super contribution of $30,000. So she doesn't need to be employed. She puts $30,000 into the super fund, and she fills out a particular form that says, I'm going to claim this as a tax deduction. She'll pay 15% contributions tax on that money, but the net saving, that'll reduce her tax by taxable income by $30,000. It'll reduce her tax significantly from $12,000 down to $2,800, but she will pay $4,500 contributions tax. Overall tax has been reduced by $5,000. So we can see here, just this couple, by planning ahead a bit, they've been able to save, what, $11,000 odd just by planning ahead and making some contributions to super to offset these gains. So if you look at the scenario, rather than paying $9,625, we've got a tax saving of $4,000 for Joe. We've got a tax saving of $3,800 for Mary. And so rather than paying $18,500, they're paying something like $7,846. So yeah, as I mentioned, $11,000 or around $11,000 in tax savings. So 2 different methods. One's through salary sacrificing to super. The other one's by making personal deductible contributions to super. Oh, sorry, $10,654,000 in tax savings by implementing that strategy. So the key thing here with Mary's scenario is making sure that she's eligible to make those deductible super contributions. And the key things are these points. You must be contributing to a complying super fund. You can only claim a deduction in the income in which the year that the contribution is made, so you've got to make it in the year that you trigger the gain. You can't be 75 years of age. You must have lodged a tax return, so you must have lodged a valid notice with the trustee. That's that form that I was talking about. And you must be entitled to contribute to super. There's also a 10% rule, so you must generate only 10% of your total income from employment purposes if you want to do the Mary track, that personal deductible contribution.